There's the gold and silver story, where ability to repress and marginalize gold as a key reserve asset is reducing. People shouldn't lose too much faith. The AI, the risk off, and a major tech bust, because I don't think you force gold down that easily. It's also not going to be over in a second either in terms of the pullback. Technically, we've got shooting stars, which are actually exhaustive and reversal moments. The largest amount in the product was gold exports to a combination of Hong Kong and Switzerland, which often sees further refinement, and on to China. The money is going east, as we've warned many times. The Chinese don't want the treasuries, they don't want the dollars. Inherently, anything they're building in surplus, they are rotating into precious metals. So we think there's going to be opportunities to the short side, but that's for traders. So if your primary audience is blue pot investors without leverage, I think the buying moments are coming, but maybe you'll get a slightly better price still to come in gold and in silver.
A lot has happened since the last time we spoke about 4 months ago. Specifically, gold prices have fallen sharply, down over 11% in June, 30% from the peak earlier this year. I'm wondering what your sense is of the markets. Is there more downside ahead for gold? What are you looking at? Where's your head right now?
Yes, a couple of things, actually. There's the gold and silver story, which I'll answer your question on. Other things, just notices the AI tech boom, which we can circle back to later, I'm sure, and how to get that right for when it might top out and start to come down. Your question, gold and the precious metals more broadly. Strait of Hormuz kind of really got hot on us in February, and we had the peak in the end of January with gold and the run-up. It was moving very, very quickly. Round about the tail end of 24, we'd said $2,000 is going to fall for the first time on a sustained basis, and we're going to run higher than 3,000 was the target. And not only did we do 3,000, but we had more setups along the way, continuation, and the top out was actually 5,600. So one of the most important things for everybody to remember, I think, in all of this, Maggie, is that we've had an exceptionally good run, and it's only a small leg in what I see an ongoing good run. I'll make reference to the chart, but overall, to give the short answer to your question before I get too technical on charts, people shouldn't lose too much faith.
Gold's sharp decline may be creating more opportunity than danger for disciplined investors. Francis Hunt notes the market has already delivered an extraordinary advance, making a correction far less surprising than the headlines imply. What many overlook is that strong bull markets rarely move in straight lines, and temporary weakness often resets sentiment before the next advance. Investors who confuse volatility with failure risk selling precisely when long-term positioning becomes most attractive. Next, Francis Hunt reveals why today's pullback carries a technical signal. Most investors are interpreting backwards.
It's also not going to be over in a second either in terms of the pullback. And you'll see when I refer to that technically, we've got shooting stars, which are actually exhaustive and reversal moments. So we could have a more prolonged pullback because of what we did. But in the longer run, we will base out and reassert. We expect continuation rather than this being a top. Same goes for silver and platinum. So let me give you the short answer and hand back to you.
Yeah. And I think that we're going to dig into exactly what you're seeing. We have a lot of people in our community who are either in real assets or interested in real assets, trying to figure out what to do with their portfolio. And we're going to throw some links in for all of you if you'd like to join the community and get some help with your portfolio. But I think the big question, Francis, is what is happening with prices? So walk me through the kind of nitty gritty here. Is it time to buy? Do you have to be patient? If you are newer to the gold market, how do we need to think about this action? Are we in a more volatile period? These are the questions we're getting from our audience. So walk me through what you're seeing in your charts.
Yes. So there's a technical and a fundamental narrative potential to both. So I do watch both, but I'm predominantly decision-based off charts, which means the technical answers where I refer to first. And then there's also a fundamental assessment. When they diverge, I get concerned whether I've got my facts straight or my chart reading straight. So I like to see a certain degree of alignment through both arguments.
The most expensive investing mistakes usually happen when people demand certainty before acting. According to Francis Hunt, the current chart structure favors patience rather than panic, with technical exhaustion suggesting the correction may take time before the larger trend resumes. That's exactly when emotional investors become vulnerable to buying tops or selling bottoms. Preserving wealth often depends less on predicting tomorrow's price than recognizing where the broader cycle is unfolding. Next, Francis Hunt exposes why one overlooked chart pattern could completely change how this correction is interpreted.
Then there's the trader, which is where you use leverage and you go long or short. And then there's the macro investor, which I refer to as blue pot. So we sort of have blue, orange, and red. Sort of orange means a little bit of leverage and red means shooting for the moon. So everything I'm saying now is going to be on the blue pot level. And your question is, should people be buying? In other words, is it an opportunity to accumulate on the blue pot level for me? So that's how I'm interpreting your question. And I'll just highlight on the charts, and I'm circling this particular candle. What's really interesting that we're speaking today, Maggie, it's actually incredibly fortuitous. We have baked in the 6-month candle, literally. So we're Monday, the 29th. Tomorrow, I believe, is the 30th. And that means that candle is hard baked. So it's not going to move much. That is 6 months of trade for this year. And obviously it encaptures the January super surge that saw us go 5-6. It also captures the full rejection thereof and a little bit extra put on to the downside. That particular candle is known as a shooting star. And when I always like reverting to the big time frames when you get a little bit of confusion, market confusion. It's not plain sailing. It's quite easy to see that is a medium term now rejection. It's not a short term rejection. What typically follows those kind of candles is another red candle of some form because of that momentum to the downside, which brings me into the story potentially of the AI, the risk off, and a major tech bust, because I don't think you force gold down that easily.
A single 6-month candle can reveal far more than weeks of daily headlines. What Francis Hunt is highlighting is the difference between trading noise and strategic accumulation, a distinction many retail investors never make. If broader markets finally unwind after years of AI-driven optimism, precious metals could decline briefly before capital seeks safety again. Investors focused on preserving purchasing power should prepare emotionally before that volatility arrives. Next, Francis Hunt reveals why weakness in gold may actually signal deeper problems inside the stock market.
In fact, talking fundamentally now, the last 5 months, the reason America didn't run record trade deficits with China is because of huge amounts in the product section. So there's products and services. The largest amount in the product was gold exports to a combination of Hong Kong and Switzerland, which often sees further refinement, and on to China as well. So the money is going east, as we've warned many times before when we've shown up with you, which should be a concern for most Americans. You're being hollowed out. The good stuff is being picked off. The Chinese don't want the treasuries. They don't want the dollars. Inherently, anything they're building in surplus, they are rotating into precious metals. So they are utilizing it to buy. So you could argue they are blue pot buying. Other central banks are also expected to be accumulating. They aren't perfect bottom callers, however. And if we're to have a real further contagion, which I anticipate is possible, you will see another red candle potentially here. The best outcome, if I was just to be a guessing man and draw you an outcome for the next 6 months, the best outcome for us would be another small body candle, but with a big rejection wick to the downside. That's how you would negate that. So if you traded down to 3.3, for example, and reverse back up, what you've done is you've given an echo exactly as what brought the fear and the danger, the shooting star, and said, not any further, buddy. And in fact, if you're coming down here, we're having all of it and we're going to add a little bit on the other way. So that would negate the shooting star, and that would be called a hammer. It could happen. The first 3 months could be the downside.
Central banks keep adding bullion, while public attention remains fixed on daily price swings. Francis Hunt's argument suggests institutional buying is driven by long-term monetary strategy rather than perfect market timing. That's an important distinction because governments don't need the exact bottom when they're preparing for structural currency shifts. Retail investors often wait for reassuring headlines, while official buyers quietly accumulate through uncertainty. Next, Francis Hunt exposes the chart formation that could confirm whether institutional demand is overpowering short-term selling.
I think between now and October, the sell in May, I think when we last time saw you, we said sell in May, go away. We said new Fed chair, typical bad trend for a lot of clearing. And we also highlighted the bond rates and a lot of downside other risks. I'm trying to remember the third and the fourth point, but we gave 4 points why you should be pretty cautious mid-off because of the seasonality, the Fed seasonality, and then generally the precarious hypervaluations of the stock market, the listings and various other things that have been going on. So overall, this is not a great time to be leveraged long too much. That's one of our primary theses. We think there's going to be opportunities to the short side, but that's for traders. So if your primary audience is blue pot investors without leverage, I think the buying moments are coming, but maybe you'll get still a slightly better price still to come in gold and in silver in the short, medium term. So if you're dollar cost averaging, carry on. You're doing great. You're going to keep buying lower into a potentially softening trend. If you're going to put in a massive lump sum and you've really it's a substantial amount, you might want to add a bit more timing onto that. Potentially, you could get a lower entry price. I don't think it'll be outrageous, however.
Yeah,
but that's one of our positionings. Let me hand back.
Yeah, so I think that's so interesting. And listen, I think that, even people who are longer term investors, I feel like now maybe people have different accounts. So it's good to hear all of the options.
Wall Street celebrates rising markets even as valuation risk quietly compounds beneath the surface. This is where Francis Hunt's thesis shifts from price forecasting toward disciplined capital allocation during unstable conditions. Rather than chasing momentum, he separates leveraged speculation from long-term wealth protection, an approach often ignored during euphoric markets. For investors safeguarding retirement savings, patience may become a stronger asset than prediction. Next, Francis Hunt unravels why today's seasonal weakness may be masking a much larger opportunity.
One of the things that I think concerns folks is, and I'm glad you put this long-term chart up that we're looking at, because you can get really caught up in the moment. And I think that's what happened at the beginning of the year. And everyone thought we're in a different era, right? We've got all these risks we keep hearing about. But it's when you see that sort of long trajectory up, I think that's encouraging. What some people worry about, though, is those very long years of sideways action that you saw when it was sort of felt like metals were dead, right? Like nothing was happening. And I think that did we condense a decade's worth of gains into a few months at the turn of the year? I think that's a concern for some. Did I miss it? Did everything happen in this very short period? And if I missed that rise, now I'm sitting here with gold and it's going to do nothing for years again.
No, is my answer. Short answer,
yeah.
No. So what's actually happening is the ability to repress and marginalize gold as a key reserve asset is reducing. That's what the chart is showing me. So the sideways pause area, the most successful period was post the boom of 81. And essentially we had 20 years. Right the way through to the year 2000 when gold bottomed and started to turn. Then I will highlight you had a very sustained and lengthy bull run that was incredibly beneficial from $200 to 1927, almost 2000. You're talking about a 10x move within quite a reasonable time, 12 years, 10 times up. I think most people will take that, Maggie.
The biggest investing regret often comes from assuming the entire opportunity has already passed. Francis Hunt notes that history shows gold's strongest advances have followed long periods of skepticism, not universal optimism. Today's debate isn't whether metals already moved enough, but whether the monetary backdrop has fundamentally changed in their favor. Investors focused only on recent gains may underestimate the much larger structural cycle still unfolding. Next, Francis Hunt reveals why every consolidation phase has become progressively shorter.
It's a very good return.
Yeah.
It sounds like a long time to wait. The young guys need to slow down. The older guys are okay with that. Then the next pullback period was shorter still by quite some difference. So that question I've had asked before, and it's one I'm used to answering. So there's your duration of negative period to be holding metals. It wasn't a good hold. You've got to own that and accept that. You can't be a perma gold bug. It was much better to be leveraged tech equities during that period. Then you have this period over here. In fact, 2016, the Shanghai Accord with the China issues was the bottom, but you can argue you only properly technically broke out around here. That is quite a lot less by duration period than the 20 years you had here. We're talking around the highs of 2011, 2012, mid 2011 to, 18, you were already coming up quite strongly. Then you had 3 years where 2000 was the rejection. You may recall me saying once, twice, 3 times, and then a lady, in tribute to the old Lionel Richie song. If you remember that, if your 80s hits are still ringing in your heart, Maggie. But then once you got that, it's a much shorter duration. So you've got 20. Here you've got let's say 11 to, it looks like 19. You've got about 8 years. So you've gone 28. This was 3. And now you're having 1 rejection. So that's why I said it's not beyond the realms of possibility. You get a little bit of froth blow off. Some weekends definitely are on the leverage side, which is why I say to the blue pot people, I haven't disaccumulated any precious metals. Just to qualify.
Every cycle leaves clues, but only if you compare today's pattern with previous decades instead of last week's headlines. According to Francis Hunt, the periods of stagnation in precious metals have steadily shortened as global financial imbalances intensified. That historical compression challenges the belief that investors face another decade of waiting. Missing that shift could prove far more expensive than enduring temporary volatility. Next, Francis Hunt exposes why patient holders may be entering a very different monetary era than the last cycle.
I moved country once, so I sold a silver holding that I didn't want to transport, and I immediately replaced it in another jurisdiction. Apart from that sale, I didn't disaccumulate at the investment level gold, silver, or platinum, and I include platinum in that. I'm quite bullish platinum at any point, and I continue to add to it. So my weight by metal continues to grow. And my overall opinion is that people should sit on their hands now and get ready to get a bit of a discount window that might be offered in the next month. It could be 2 months, could be 3. We'll be monitoring that. But to answer your question, the durations of rest periods is shortening, and that's because the fiat and debt-based collapse that we referred to immensely in previous appearances with you is more critical and more chronic than before. And the actions of China and, of course, Biden on the confiscation and many other events are moving towards a gold-warranted, vaulted type system by the largest producer nation on the planet. That is incredibly supportive, and the price data is showing that. This is not a Francis Hunt constructed narrative. You can do this calculation for yourself. There were the last pause, and then you were breaking out there. That was your 3 years. It is getting shorter by rest period, and it is moving immensely once it goes. So this is
so interesting, Francis. I think this is a very, very important chart because in my mind, it answers some of the comments that we will inevitably get, under this video.
The market often offers its best discounts when confidence is at its weakest. What Francis Hunt is highlighting is that accumulating during measured pullbacks may matter more than trying to predict exact bottoms. Meanwhile, rising debt burdens and changing reserve strategies continue evolving regardless of short-term price action. Investors protecting purchasing power should watch structural trends, not daily volatility. Next, Francis Hunt reveals the overlooked cycle that suggests monetary stress is accelerating beneath the surface.
Which is, listen, you've been warning, and other folks, who are like-minded have been warning about the unsustainable debt levels and the reckoning that's coming, but it doesn't happen. It keeps getting pushed out. Why haven't we seen more fallout? But this chart suggests that it is making a difference. It's shortening. Each cycle gets shorter. So there is some sort of change happening.
Absolutely.
But
It's
why
cumulative.
do you think, I think people, when they think of reckoning, it's going to be sort of, this global, when you say a reckoning, what does that mean? And does it get pushed out? What is pushing it out further?
So there's two questions, I think, lurking in there, Maggie. One was, what does it look like? Well, I'll give you an example of some material I was reading just now. You take a country like Brazil that's struggling and has to run much higher interest rates. Emerging market nations have suffered at the behest of the dollar dominance in the fiat currency. Same for the South African rand and other countries that I've visited and know quite well. They have to run very high rates, otherwise they have currency crises. And that's largely because of the might of the dollar and the way the trade system of the world is. If Brazil gets paid for its cashew nuts or all its other agri products that it generates in gold warranted and not dollars, they will not have a regularly depreciating currency on their hands, but they'll need a lot less dollars, and other people will lend their currencies or happily accept them buying goods.
The real monetary shift rarely begins with a market crash. It starts when countries quietly change how they settle trade. Francis Hunt's argument suggests the gradual erosion of dollar dependence is unfolding beneath the headlines, not through dramatic announcements but through evolving financial incentives. The slow transition matters because reserve demand changes long before retail investors recognize it. Wealth preservation depends on seeing those shifts early. Next, Francis Hunt exposes the hidden mechanism quietly reducing global reliance on the dollar.
Against that gold, what you get is a reduced need for dollars in the trade, the macro trades, all the ships running around. This is a big part of the movement of money. And the minute that starts happening, hedging for dollar reduces, the bank availability, all of this gets smaller. There's a knock-on effect once people start de-utilizing the dollar. It's still the most dominant for everything. It's not saying that it isn't. It just means the trend is in the wrong direction. What that does is it starts gnawing away at demand. And you then get the high interest rates, which is why we keep highlighting the debt aspect because of debasement on the debt. And the other nations that are disaccumulating dollars and accumulating vaulted gold in trade start to undermine it. So the system that the China has put in place is a very slow but deadly erosion of dollar dominance. And anyone who doesn't see that is not watching the game turn. It's slow motion, but it's coming. Each time it's coming, and it's bleeding away.
The dollar doesn't have to collapse overnight for investors to lose purchasing power over time. This is where Francis Hunt's thesis shifts from market speculation towards structural monetary change, arguing that declining trade demand can steadily weaken reserve currency dominance. The contradiction is that policymakers still project confidence, while many nations quietly diversify their reserves. Long-term investors ignore that transition at their own risk.